Welcome to Tanner DeWitt Tech Byte. My name is Tara Chan, and I am part of the Corporate and Commercial Department. This is Future Equity Agreements for Founders. Future Equity Agreements, or more commonly known as Simple Agreements for Future Equity, SAFEs, or the equity version of Keep It Simple Securities, KISS agreements. Future Equity Agreements are agreements between the investor and company where the investor agrees to pay a certain amount for shares that will be issued to him later on. The shares are usually issued on the occurrence of a trigger event, such as a qualifying funding investment round or a liquidity event. Upon the trigger event, the invested amount will then be used as the subscription amount for shares in the company. What are the benefits of future equity agreements for founders? They have become very popular for early stage startups in the community because they are typically simple and short agreements that are relatively low cost for startups to raise funding. Being shorter agreements, usually they are easier to negotiate. They are not recorded as debts in the accounting books. They allow flexibility for the startups. There's usually no set date of conversion, so this gives flexibility to the startup before any obligations must be met to the investor. There's also no certainty that a trigger event will happen. If no trigger event happens, then the company does not owe an obligation to the investor to return the investment amount. What are some general terms of future equity agreements? The first would be the amount invested by the investor. Then there would be the explanation of the trigger event. Trigger events can be change of control events, funding rounds of certain amounts, the company issuing shares in a particular share class, could be an event agreed by the parties, or any combination of these. Next would be the calculation or the basis to convert the investment amount into the shares of the company. There would also be an explanation of the share class or the types of shares that the investor will receive. These could be preferred shares or it could be non-voting ordinary shares, whatever is agreed between the parties. There's also the mechanism for the company to notify the investor that a trigger event is about to happen, so that the investor can then inform the company to use the investment amount as a subscription amount to purchase shares in the company. This is known as also the exercise date. There would also be notice provisions so that it provides how the parties will communicate to each other. How do you calculate the shares that will be issued to the investor upon a trigger event? The two most common ways to calculate the shares to be issued to the investor are one, there's the discount. So the company will give the investor a discount on the shares issued to him in relation to the shares given to other investors or purchasers who bought the same class of shares. We have seen that the market standard for this discount is usually 8 to 20%. The next method would be the cap method. So this is where the company will create a maximum cap amount and then dividing this cap amount by the total number of shares of the company issued on the exercise date. There are certain modifications to calculating the shares of the company, such as you can take into account the total number of shares of the company on a fully diluted basis. This means counting as if all the options, convertible security instruments, have been converted into shares. The company can also take into account the shares that are to be issued on the trigger event. The parties can use either or both and combine these with even more terms such as a most favored nation clause. Founders should push for only providing the discount. We have seen that investors push for the better of using the discount or the cap method. Future equity agreements are usually only suitable for early stage startups, such as pre-revenue startups, or if it is difficult to value the startup. Because future equity agreements are very simple and unsubtle agreements. As the startup business grows and becomes more conscious in terms of financing, then a convertible loan note would be the more suggested approach. This is Future Equity Agreements for Founders. My name is Tara Chan. If you have any questions, please feel free to reach out to us at Tanner DeWitt.